Let's be honest, the high-stakes Connecticut real estate market can look like an absolute monster when you first approach it. I mean, we're talking high property values, endless variables, and major life-changing financial commitments. But hey, welcome to this explainer. Today, we're going to conquer that monster together. We're going to take all the complex data of home buying in the Constitution state and turn it into a crystal-clear roadmap.
Okay, let's dive right into the most vital question. Can your budget actually handle that dream home? The absolute biggest fear most new home buyers face is the dreaded money surprise. Finding out after the fact that the property they completely fell in love with is stretching them way too thin. Buying a home here requires serious, strategic planning before you even think about putting in an offer.
And this number tells you exactly why. Connecticut isn't just any market. It's literally the wealthiest state in the country, boasting an average income of $93,000. Because we're operating in such a high-income, high-property value environment, guessing at your numbers? Yeah, that is simply not an option. Knowing your exact financial boundaries is absolutely non-negotiable if you want to succeed here.
So here is our roadmap for today. First, the CT Real Estate Challenge. Second, why use a calculator? Third, decoding jargon. Fourth, hidden costs. And finally, steps to success. Let's get to it.
Part 1. The Connecticut Real Estate Challenge. Let's talk about predicting your costs. If you try calculating your mortgage by hand, well, you're setting yourself up for a slow, error-prone headache. It's incredibly difficult to manually manage variables like local taxes. But with the digital calculator, the process is instant. It accurately handles those complex variables like taxes and insurance and delivers consistent, reliable data every single time. Honestly, doing the math by hand is a massive risk. A digital calculator is your reliable financial weapon. Moving on to Part 2. Why use a calculator? Think of this as your financial GPS.
A key quote from our source material really hits the nail on the head. Financial peace of mind comes from knowing exactly where your money is going before you commit to a long-term debt. Using a Connecticut Mortgage Calculator isn't just some boring math exercise. It's entirely about empowering yourself. It's about visualizing your potential monthly costs to totally eliminate stress before you ever sign on the dotted line.
Testing different scenarios reveals some incredibly critical insights. Take a look at how jumping the loan amount drastically changes your monthly payment. Say you get a 6.5% interest rate on a 30-year term. A $300,000 loan runs you about $1,896 a month, but bump that loan up to $500,000 and suddenly you're looking at $3,160 a month. Even a small change in what you borrow heavily impacts your daily life. This is exactly why you must test your options before committing.
All right, Part 3, decoding jargon. Let's neutralize those scary real estate acronyms.
The absolute most important acronym you'll encounter is PITI. This stands for the 4 core parts of your housing cost: principal, interest, taxes, and insurance. Your principal is the money that actually lowers your loan balance. Interest, that's the fee you pay the lender for borrowing the cash. Taxes are your monthly property tax contributions, and insurance protects the physical home itself. Knowing these 4 elements means you know exactly what is eating into your monthly budget.
Next up, escrow. Now this sounds super complicated, but it's actually designed to make your life easier. An escrow account is simply a holding tank where the lender keeps a portion of your monthly payment specifically for taxes and insurance. When those giant bills are due, the lender just pays them for you. It keeps your critical payments perfectly on time, meaning you don't have to scramble for cash twice a year.
But here's an acronym you really want to watch out for: PMI, or Private Mortgage Insurance. This is an extra monthly fee that protects the lender, not you, if you can't pay your mortgage. Lenders typically require it if your down payment is less than 20% of the home's value. This is exactly why hitting that 20% down payment is such a phenomenal goal. It completely eliminates this extra monthly burden from your budget.
You're also going to have to choose your loan type. A fixed-rate mortgage stays the exact same for the life of the loan. It's highly predictable and gives you ultimate peace of mind for the long haul. On the flip side, an adjustable-rate mortgage, or RM, gives you lower rates at first, but it changes periodically. An RM is variable and moderate to high risk, sure, but it might actually be perfect for someone who knows they are moving or selling in just a few years.
Section 4, hidden costs, because it's never just the base mortgage.
Listen, before you even move in, you're going to face closing costs, which generally run between 2 and 5% of your total loan amount. You need those funds ready up front. Then there's maintenance.
You should be setting aside 1 to 3% of your home's total price every single year for inevitable repairs, like a leaky roof or a blown water heater. And finally, don't forget your everyday utilities and potential homeowners association dues if you're looking at a condo. You absolutely have to add these into your calculator estimates to avoid nasty surprises later.
So the big question is figuring out how to afford all this safely. The famous 28-36 rule is a fantastic strategy to make sure you stay in the driver's seat of your finances. Basically, your housing costs shouldn't exceed 28% of your income. And when you add in all your other debts like car payments or student loans, your total debt should stay under 36% of your income. That leaves a comfortable 64% for, actually living your life. Finally, Section 5, Steps to Success. Let's build your actionable plan.
Using a Connecticut Mortgage Calculator is way simpler than you might think. Step 1. Find a robust online calculator and grab your basic financial documents. Step 2. Input your target home price and your planned down payment. Step 3. Choose your loan term, usually 15 or 30 years. And Step 4. Enter your expected interest rate. By just walking through these 4 quick steps, you instantly turn an overwhelming mountain of market data into a simple, highly personalized action plan.
Now, a quick reality check. Calculators provide highly accurate estimates, especially if you customize them for things like local Connecticut mill rates for taxes, but they are still just estimates. The calculator is an incredibly powerful starting point, but getting pre-approved by a licensed lender for your exact costs and consulting a financial advisor for your long-term wealth plan, well, that's your ultimate finishing move.
So, I'll leave you with this provocative thought. What will your Connecticut numbers reveal? You've seen exactly why navigating the wealthiest state's real estate market requires strategic preparation. You understand the hidden costs, the tricky terminology, and most importantly, why calculating your outcomes before you buy is the absolute key to financial peace of mind. It's time to step up, use the tool, and take total control of your financial future. Run your scenarios, get your baseline, and happy house hunting.